Welcome, everybody. Okay, so today I am going to break down the save and spend system in the most consumable way that I've personally been taught. Now, understand, when I use the phrase save and spend, I'm referring to the infinite banking concept and the book Becoming Your Own Banker by R. Nelson Nash. So let's go ahead and start off with the product, because before we get into the process, you need to understand the product being utilized. So the product is insurance. Now, there's a lot of different types of insurances out there. I think we can agree that the average person has probably at least 2 to 3 different kinds. Let's be honest, when they got them, they didn't read the paperwork. They don't know exactly how they all work, but they might be able to recall what the person who sold it to them said, which is totally normal. I'm the exact same way. So here are some of the basic types of insurance that you might have: car, phone, home, health, and life, just to name a few. Now, as I'm sure we all know, the main focus of insurance is to take the risk off of you and place it on the insurance company who is insuring you. It doesn't matter what type of insurance it is. The idea is to transfer risk. I think the main reason why so many people look at insurance in a negative light is because there's so many different types of insurances that never actually need to pay out. For example, maybe you never get into a car wreck. Maybe you never flush your phone down the toilet. Maybe a tree never falls on your house. So you spent all of this time paying for something that you never actually use. Trust me, I get it. That definitely sucks. But let's go ahead and shift gears now and talk about life insurance, because this is without a doubt the best product there is to practice the infinite banking concept, aka the save and spend system, with. Now, you and I both know that there is a big difference between the possible outcome of what's going to happen with your car, with your phone, with your home, and the guaranteed outcome of what's going to happen with your life. Now, let's be honest here. Personal question. Do you know anyone in your life that is not yet and will never pass away? I didn't think so. Neither do I. But if you have the right life insurance policy, there is a guarantee that your policy will pay out to your friends, family, church, or charity, all up to you. You see, the big difference is you hope one never pays out. For example, your house burning down. And the other one you hope does pay out, because that's tax-free money that you want to leave behind to your family. Now, we just went over a bunch of the other different types of insurances, but let's talk more specifically about the different types of life insurance out there. I'm sure you're aware that there's more than one type. So my goal is to make this as easy to understand as possible so that you know exactly what we're talking about when we get to the topic of infinite banking. And I promise you, don't worry, it's coming up here soon. We just got to lay a little bit of foundation. So the first type of insurance is term. You can basically just call this rental insurance. Not only is it the most popular type of life insurance out there, but it's also the most profitable for the companies. The most common term lengths are going to be 10, 20, and 30 years. Basically, what the insurance company is saying is, we'll allow you to rent this insurance for a certain period of time, rent this death benefit. Let's say you choose the 20-year term. And let's also say you pass away in year 21. Well, unfortunately, my friend, your family receives nothing. Nada, zilch, zippo. What you probably weren't told when you were buying your term is that 98 to 99% of these policies will never pay out, because the majority of folks tend to just outlive them. Think of it like your car insurance. You never use it if you don't get into a crash. So that's the first type of life insurance and the most popular. The second type is permanent, and that basically branches out into 2 different categories. So on one side you have whole life, and on the other side you have universal life. This can be a little confusing, but just to make it as clear as possible, universal life probably finds itself somewhere between whole life and term life. And the reason for that is, essentially, it's considered permanent coverage because it has the possibility to last your whole life. but it's also not really permanent coverage because it has the possibility to not last your whole life. But that's not the product that we're going to be using for infinite banking, so I'll just go ahead and leave that there. What we'll be talking about today is whole life. Whole life is guaranteed to last your whole life, just like the name says. Whether you pass at 45 or 115, it's stated in the contract that you are covered. The last thing I want to touch on before we jump into the process of infinite banking is very important, so please listen up. When you think about insurance, the most common form of insurance that I imagine almost everyone has or can at least picture in their mind is car insurance. I imagine you've got it because you probably drive a car. Don't tell me if you don't. And I have it because I drive a car. But that doesn't actually mean that we have the same thing. You see, there are different options inside the policy, and there are different options depending on which company you decide to go with. A lot of people don't put this together, but here's essentially how I like to explain it. You've probably seen the commercials just like I have. The Allstate man with the super deep, nice voice saying that if you drive safe for 6 months, they'll cut you a safe driving check. But when you see Flo at Progressive or Jake at State Farm in their commercials, they don't say absolutely anything about getting a check. Nothing. Not once, not ever. But they're all still selling car insurance. So what I'm saying to you is that this is a couple different examples of different car insurance companies, but one of them has a different option than the others. Let's take this just a step further. I could have liability coverage, which I'm sure you're aware of, and you could have full coverage. It's still car insurance, but we have completely different coverage. My point in saying that is most people just don't realize that when it comes down to life insurance, even if you have the right type, you'll still need to understand that there are options between which one should be selected, or you should work with somebody who is a professional like myself that knows the exact thing that you need to fit what you're looking for to do exactly what you want to do, whether that's get a term policy or get something properly structured that's going to allow you to do infinite banking. Now that we've covered all that, let's go ahead and jump into the process of infinite banking. So the simplest explanation that we've adopted to help clients understand how infinite banking works is really this 3-cup setup here. So cup number 1, the red cup, is premium or premium deposit. Cup number 2, the green cup, is cash value. See the little dollar sign on there. And cup number 3, the blue cup, is death benefit. These are the 3 main cups for the 3-cup setup, but we also have a little shot glass here, which represents dividends. This one is from Thailand because your boy likes to travel. Now, this is very important. If we are going to follow the guidelines laid out in Nelson Nash's book, Becoming Your Own Banker, we need to make sure that we are not only using participating whole life policy, but we're partnering with a mutual company as well. A mutual company is a company that is owned by its policyholders. These policyholders can receive dividends on an annual basis, which here at Legacy Life, we absolutely love. I love getting dividends in my little shot glass. Now, a mutual company is much different than a stock company, which is owned by its stockholders. Now, stock companies don't pass out dividends to their policyholders, which we don't like that. We want dividends, which means we want to open our policy with a mutual company. Life insurance companies are insanely profitable, so we definitely want to partner with them so we can go ahead and take part in some of that profit. Okay, so we've got cup 1, cup 2, and cup 3. The first cup, cup 1, is your premium deposit cup. When we give an insurance company money for our policy, we call that a premium. Now, this is important to understand. Premium works the same way with any type of insurance company that you have, whether it's phone, car, home, you name it. They all work the same. Premium is the cost. Premium is the bill. You can call it whatever you want, but premium is what's coming out of your pocket and going to the insurance company. Please don't ask me when we get on a phone call, about the fees or the cost of this or that or the other thing. Every single cent is worked into the total premium. The cost will contractually never increase. That is a guarantee. The second that you pay your premium to that life insurance company, you go putting a little bit of cash right there in cup one, it buys you a guaranteed chunk of change that gets paid out when you pass away. Not if you pass away, when you pass away. That chunk of change is called the death benefit. Here we go, putting a nice big chunk of change in the death benefit. Now be very aware, this money in the death benefit cup right here is not the money that you gave the life insurance company. It is way more. So if you go ahead and pass away tomorrow, the life insurance company is on the hook to pay out this big chunk of money to your friends, family, church, or charity, 100% tax-free. No more GoFundMes, no more car washes. That money will be delivered to your beneficiary, 100% income tax-free. Now, let's talk about cup two, the cash value cup. Cup two comes into play because the life insurance company is on the hook for the blue cup, aka the death benefit, and they must pay it out because you bought it. Now, this should be helpful. Cash value can be thought of as the liquid equity portion of the entire gross death benefit. So when I'm showing people this, I like to physically pull out some of these dollars from the death benefit and slide them in to cup two, the cash value cup, so you can visually see where it came from, and it's in a different bucket for you to use, and we'll talk about that. So one of the best attributes of the cash value, the net present value of the future death benefit, is that it is liquid, meaning you can use this money. It is now an asset for you. Remember, cash value is simply just a part of the whole. But there are some folks out there, Susie Orman, Dave Ramsey, I won't name any names, that will try and throw people off. Understand, all of the information that I have given you up to this point is fact, not opinion. This is exactly how it works. The cash value is the equity that you have in this big number. Again, think about it just like the equity in your home. Luckily for you, you can use this money however you like by simply loaning this money from the insurance company. So one of the guarantees that I mentioned is that this cash value in cup two is liquid. Another guarantee is that it grows, meaning it gets bigger and bigger and bigger. Now, just like all of the other insurance products we covered, car, phone, home, health, they all have a reoccurring cost or a bill. Your life insurance policy is no different. The cool part about whole life insurance is every time that reoccurring bill or cost or deposit comes up and you pay it, so here we are, paying that money into our premium deposit cup, more of the future payout, aka the death benefit, has been purchased or bought, which means more slides over from the future bucket into the present bucket, aka your cash value. Now, if you've been following along, you know that that means your cash value grows each and every year, every time you pay the premium. Guaranteed, no questions asked, it just keeps getting bigger. The third attribute that we need to understand about the cash value is that it is a loan. We are borrowing against our policy if and when we decide to use it, lose it, or abuse it. Therefore, it is not taxable either. It's also a loan against the value of your death benefit, which is also not taxable. There are no taxes going on in any of this. So just to recap, cash value is the liquid portion of the death benefit that we can access right now. Okay, let's get back to cup one, the premium deposit cup, and talk about its benefits. You might not know this, but cup one is the answer, and I'm going to prove it to you right now. Number one, ladies and gentlemen, cup one is guaranteed, cup three is grow, and cup two is cash flow. Guaranteed to grow and cash flow. Now, when I say cup one is guaranteed, what I mean by that is you cannot lose it. It doesn't go backwards. It doesn't go down. And why is that? It's because it's backed by a bigger amount over here, the death benefit. It's not an investment strategy. We can't lose in the market because our money is not in the market. That is very important to remember, because whole life insurance has absolutely nothing to do with the market. It is not an investment. Your money is not in the market. Do not compare these two. It's like oil and water, completely different things. Okay, so it's guaranteed not to go down or backwards. It's also guaranteed to grow, meaning if we give the insurance company premium, it's going to buy a larger pool of money, just like it did when we originally started out. You put a little bit in, you got a whole lot more coverage. And the third thing is that it is level. This is very important, so pay attention. Your car insurance bill can go up. Your home insurance bill can go up. Your phone insurance bill can go up. When you're using a participating whole life policy for infinite banking, the bill cannot go up. It is level, and they will contractually never change that on you. So like I said before, premium is the answer. Premium is not the question. The question isn't how much does it cost? How much do I have to put in? The question is, how much will they allow me to put in? Every dollar that you decide to give to the insurance company has guarantees and growth on it. So, as we like to say at the Cash Compound, every dollar that you save here in cup number one can be spent over here in cup 2 and 3. And that's why we call it the save and spend system. The cool thing is every dollar that you decide to give to a mutual company for a whole life product is going to kick off separate pools of money that you can then spend at the same time. So if we decide to use any of the money in our cash value cup, which we highly suggest that you do, and we'll teach you the many ways that you can do just that. But if you decide to use that money, your money is still growing over here in the premium deposit cup, completely uninterrupted, because you have not touched a single dollar of this. When you're spending money, when you're loaning out money, remember, it's coming from cup number 2, the cash value cup. Okay, now let's start actually discussing using your cash value. Now, I'm going to start using some banking terms because I want people to understand what we're doing here is creating a bank. It just happens to come with a death benefit built on the chassis of a life insurance policy. But don't get it confused. We are doing banking. Remember our guidebook here, our field guide for doing the process from R. Nelson Nash himself, Becoming Your Own Banker, the 5th edition. Go ahead and click the link down below and head on over to Amazon and grab yourself a copy of this book because this is extremely important. So go snag yourself one right now. Okay, so of course we want to know, how can I start utilizing my policy and how can I become the banker? So if we want to become the banker, we have to start banking with our policy. And what I mean by that is mimicking your average everyday local banking institution and what they're doing with the money that they get. That's all it means. Mimic what they do. So if you're unfamiliar, let me paint a picture for you. You get a paycheck. Almost everyone does. Whether it's weekly, bi-weekly, monthly, whether it's commission, whether it's bonus, it doesn't matter. But people, when they get a paycheck, what do? They give it to the bank. That means the bank has lots of money because everybody on your street gave their money to the bank on Friday. It's just how it works. Bank's got your money. But the bank doesn't just leave your money there. See, think about it this way. If the bank took your money and just left it there in the safe, how in the world would the bank pay their electricity bill? How would they pay their employees? They couldn't. So they have to go and make some of their own money. And the resource that they have to do just that is your money, because you and everyone else just gave it to them. And so what they do is take the money, technically speaking, belonging to someone else, and they loan it out for things like cars and houses and credit cards and kitchen remodels. What else do they loan it out for? Oh yeah, those amazing student loans that we all love so much. They loan it out for stuff. just regular everyday stuff. And when you get that loan, because the bank is in control, they force you into repayments. That's the strategy that we want to mimic using our banking policy, except we're in control, not the bank. We want to take the cash value, technically speaking, the net present value of the future death benefit that the insurance company put there. I didn't drop all this big money off over here. They did. So I'm going to take some of it from the cash value and I'm going to loan it out, whether it's to myself, like a personal loan, whether it's to family or friends or other business opportunities that present themselves, like maybe real estate. And what can we loan it out for? Well, Sean, houses and cars and putting fences in the backyard and kitchen remodels or whatever else comes across your plate. But then whoever we're loaning out to, including ourselves, should repay it with interest, because that's the final step of the banking process. And that's actually how the banks make loads of money for themselves without having to spend a single dollar. Is this starting to make sense? So just as a refresher, if we take money from the cash value, cup 2, the middle cup, we now have cash to do with whatever we so choose. And our money over here in cup number 1, the deposit, premium deposit cup, is still in the game. You got to remember that. This doesn't move. The premium is what makes the whole thing go round. Here it is. It's still here. It's still guaranteed. It's still buying a death benefit, and it's still growing and earning dividends. Damn, this is good, man. I hope you guys are catching on to this. Okay, so over the course of time, we can take in new income or other people's money, OPM. Gotta love OPM. You down with OPM? Yeah, you know me. And we can replenish the full value of the policy. But this is where we start to get into the profits here. All right, pay close attention. So we've put back what we took out. Follow along? How in the world does the bank make money if they're just loaning it out and people are giving it back at the same rate? So let's say that the bank loans out $50,000 for you to buy your new car. I was going to say truck, but I don't think you're getting a truck for $50,000. So they loan out $50,000. You pay them back $50,000. How much money did the bank make? They didn't make any. So now the bank and you need to be thinking about extra interest. So if you decide to pay yourself interest, because remember, you own the bank. I know you probably forgot that by now because you're probably in your head trying to figure out some numbers and stuff, which is it's totally cool. But when you pull dollars out and you spend them on whatever it is that you want, while your money is over here, still sitting in cup number 1, premium deposit cup, and over time, you or the other people that you've loaned it to put it back. You've replenished it, so it's liquid again. It's back in here to use again. The interest you might charge yourself or others, whatever it is, now goes into a new money bucket, aka the premium cup or cup number 1. Now remember, when more money goes into the premium deposit cup than was actually required, something amazing happens. Here we go. I'm putting more money into the premium deposit cup. Anytime you put money into cup 1, the premium deposit cup, you are buying something. Anybody know what we're buying here? Correct. We are buying more death benefit. Yes, here we go. More death benefit. That's called additions if you want to get technical about it. And now, because we have a bigger pool of future guaranteed value, there is also going to be new pools of net present cash, which is money moving into cup number 2, the cash value cup. Pretty exciting, right? And you might have noticed that we never lost control or put any of our money at risk. All of the dollars stayed with us the entire time. They are still there. So the original premium is still there. The cash that we took out and eventually replaced because we're playing honest banker, that's still there on top of the new interest that we added into our premium deposit cup right here. That's still there. Plus whatever you probably went out and bought during this time period that you now own. Boom. And that is the 3-cup setup, as simply as I can break it down for you. If you want to learn more about the save and spend system or want to book a completely free consultation, really just to discuss infinite banking and if it might work for you, or just get some general questions answered, because there's often a lot of those, please head on over to our website, legacylifeandretirement.com. Again, that's legacylifeandretirement.com, and book a free consultation. One more thing before you run. Also feel free to head on over to our private Facebook page called Infinite Bankers. Our team would love to usher you into our family, into the community, to have a conversation and answer questions or concerns from you at any point in time. I appreciate your time. I appreciate you making it all the way through this video. I hope this brought you some value. We look forward to connecting with you soon. Catch you later.